we've been saying that they're going to be done. They're going to have to pivot by the end of 3Q. And after the last 2 weeks, I would take way under on the end of 3Q22 when the Fed starts to pivot. Over the last 120 years, 98% of sovereigns that had debt to GDP go to 130% ended up defaulting.
This is Luke Gromen. He's a macroeconomist and frequently comments on global macro events and the markets. You may have seen or heard him on the various investment podcasts online, or maybe you've seen him on various business media networks. As you saw in the intro, he has a rather bold prediction that the Fed will pivot by Q3. And he premises this prediction on the U.S. fiscal position and the over-indebtedness that the U.S. is currently in. So he basically says that in the short run, U.S. expenditures will remain high due to things such as entitlement and defense. And on a longer run secular basis, these expenditures will only rise due to things such as aging demographics. And he makes the rather interesting argument that in 2021, the U.S. saw very high nominal GDP growth of over 10%. And of course, this came with, by year-end, 7% CPI inflation. And this all resulted in record tax receipts for the government. But these tax revenues still barely even covered mandatory spending, let alone everything else that the government wants to spend on. So this basically is where Luke Gromen's sovereign debt crisis comes into play. If the Fed continues tightening, it will lead to a further decline in asset prices, which will mean that the economy will contract. And if the economy contracts, tax receipts will go down. And this will balloon the deficit even more. And if the deficit climbs, then interest rates will rise further, which will put even higher pressure on the government and on the economy. And here his debt crisis prediction comes in. So to avert the situation, Luke Gromen argues that the Fed is going to have to reverse and step in to support the bond market and suppress interest rates so the government can remain solvent. Okay, so let's take a closer look at the U.S. fiscal position. One that Luke Gromen says is so problematic it will force the Fed to pivot. So here are numbers from the White House and the White House's budget for the year 2022. And you can see mandatory spending at a little over $4 trillion. And this includes Social Security, Medicaid, interest payments, which I've highlighted because we will get into that further. It is a key aspect to Gromen's theory. And then other spending such as employment insurance and other entitlements. Recently, Congress just passed $782 billion for defense spending, and that's for this year. And we compare this total cumulative spending between mandatory and defense, and we compare that to 2021's actual government tax receipts, which came in at slightly over $4 trillion. And this is a record high. The previous high was only actually $3.5 trillion in 2019. But you can see, looking at the chart to the right, a comparison of mandatory spending in defense and then government revenues. You can see there is a big difference. Current record high tax receipts only cover around 80 something percent of the spending. And now for a deeper look into the tax receipts that the government collected in 2021. And basically the record tax receipts that government has seen can only covers entitlements and projected interest payments. And it's noteworthy that these interest dues from the government is based on a 90-day treasury at 0.2% and a 10-year bond at only 1.4%. And you can see that on the chart below, which is the White House's economic assumptions and projections. And obviously this is far lower than the market value. And with the Fed funds rate now at 2.25 and 2.5, between 2.25 and 2.5%, and expected to rise, and with the 10-year bond yield at around, well, it came down a little bit, but still hovering around 3%, interest payments are only poised to rise. And of course, this will put even further pressure on the government deficits. And we compare that to the tax receipts from 2021, and these tax receipts are, as I mentioned, record highs and juiced by QE and stimulus in an economy that grew nominally at over 10%, and with CPI by year end at 7%. The US really is in no position to have a recession or any meaningful decline in its tax revenues. And that's just because of the nature of its spending and the fiscal position that it's in. Now, looking at the long run, this deficit issue is only expected to expand, as if you look on the left-hand side, a chart of the age 65 and older population in the U.S., which is just projected to grow. And of course, this is the demographic that are the recipients of a lot of entitlement spending and will help drive the debts further. And then on the right, you can see a chart of Social Security, Medicare, and Medicaid, the big three government expenditures, over the next 10 years as a projection, and it's just expected to grow quite significantly. On the chart here, you can see the expected, according to the Congressional Budget Office, the expected government spending versus revenues over the next 10 years. And you can see on the red line on the bottom, the expanding deficits that is projected for it to run. And on the right, I've created a table or a chart that outlays the percentage of government revenues that go towards various government spending. Going over in a few years, or looking ahead in a few years, it would easily make up over 100% of tax revenues just for these mandatory items alone. And of course, it's worth noting that all these projections are based on quite rosy assumptions, where the economy is expected to grow anywhere between 2 and 3% over the next few years. Inflation is expected to be back down to 2%, and interest rates are also projected to be pretty low, as I showed you in the economic assumptions chart earlier. And of course, as we've seen in the first half of the year so far, many of these assumptions are already proving wrong. And even with a good outlook, it looks like the government will incur even larger deficits in the future. And so this is why the Fed really can't continue tightening. If tightening continues, then asset prices will continue to fall. And since asset prices are heavily linked with consumption due to what is known as the wealth effect, so the idea that people are more willing to spend when they feel wealthier. Due to the wealth effect, consumption will fall, and consumption being 70% of US GDP, the economy will fall. And with the economy falling, tax revenues will fall. And as described earlier, with the government fiscal situation as precarious as it is, if tax revenues fall, then debts are going to blow up, and the government is going to have to issue a lot more bonds in order to cover its spending. And if they do that, Luke Gromen argues that interest rates will rise. Then debt burdens get even bigger because now the government has to pay higher interest, and then the economy also has to bear higher interest. Things such as mortgages are heavily linked with bond yields. So, with that being said, the economy will be pressured, and then if the economy falls down even more, then tax revenues will fall even more, and then rinse and repeat. The cycle continues. This is really the kind of debt spiral, and is what Luke Gromen argues will happen if the Fed continues tightening, and which is why he thinks that in the end the Fed is going to prevent this dynamic from occurring by being the backstop in the bond market and in controlling interest rates, so the economy doesn't get into this sort of debt crisis depression. With that, you might be saying, hey, hold on. If the Fed tightens us into a recession, which is what is looking more and more likely with negative Q2 GDP, if you're going to a recession, wouldn't investors start buying bonds and looking for safety, and that would bring interest rates back down? Well, that is another part of Luke Gromen's theory, which is that the market is really running out of buyers for bonds, and especially as the government needs to issue more and more debt. And looking at the numbers, you can see in the charts here that foreign buying of U.S. Treasuries has certainly plateaued or even declined. You can see that as a percentage of total holders of Treasuries, that foreign buyers have made a smaller and smaller amount or portion of Treasury holders. And you can see on the news as well, just recently, Japan and China both cut their holdings of U.S. Treasuries. And then looking at the private sector, it's heavily indebted, credit card debt, mortgage debt. The corporate debt is very high, so it's very unlikely that the private sector with low savings can buy bonds. And basically, Luke Gromen is saying that the Fed is going to have to step in as really the buyer that is needed when the government has to issue more debt. And this is kind of a dynamic that's already been occurring post '08. The Fed has been an increasing holder of U.S. Treasuries. So can this situation be avoided? Can we avert this debt crisis that Luke Gromen sees coming? He makes out the point that, according to economists Carmen Reinhardt and Kenneth Rogoff, their data found that in the last 120 years, in nations with debt to GDP ratios over 130%, 98% of those nations ended up defaulting, either through austerity, restructuring, or inflation, with the latter being the most common route. He also points out another point from Brian Hirschman, that since 1991, there were 18 countries that saw deficits exceeding 11% of GDP and debt to GDP ratios exceeding 110%. And all 18 of those governments ended up defaulting. And not only that, they ended up defaulting within 2 years. So if you look historically, it certainly seems like the U.S. is facing, there's a really high chance, 98% chance that this crisis will occur. Now you may be asking, why not austerity? If the government is facing a debt problem, why not fund your spending through tax hikes or cut your spending? There's a number of issues with this. It is a knee-jerk reaction often to debt crises. You can see it in places like Greece, but often it is very unsuccessful in resolving the issue. First of all, in the U.S., Congress is very gridlocked. They can't really pass anything, and the chances that they pass tax hikes and spending cuts, which are extremely unpopular with the populace, is a very low chance. And especially given all the politicians who are seeking to get reelected. And then there's an economic side to it, which is that austerity is a contractionary monetary policy, which reduces spending, reduces aggregate demand, and reduces the final economic output. And this, of course, reduces tax revenues. And reducing tax revenues means that the deficit actually increases. And this is kind of similar to the point that I mentioned earlier, where the Fed tightening causes the economy to fall, and it causes interest rates to rise, and it causes the economy to fall further. It's the same situation where it's really a spiral. The deficit increases, and then interest rates go higher because debts go higher, and if rates go higher, then debts increase even more, and then you get the self-reinforcing spiral. So this is not something that policymakers tend to do. If you look in the past, the reason why overwhelmingly the government chooses to inflate away debts instead of going with austerity is because of these reasons. So under Luke Gromen's theory, what's next? What can we expect? Well, first he points out that over the months ahead, we're going to see significantly weaker economic data, and we'll see very large stresses on the financial markets, on the economy, and potentially even on the sovereign debt level. And this will ultimately cause the Fed to pivot. Like said earlier, Luke Gromen expects the Fed to pivot by Q3 of this year, and he thinks that by next year we're going to again see some form of QE or even a yield curve control. He expects that the dollar will fall due to this pivot, but unlike many other dollar bears, he still thinks in the long run the dollar will still remain as the primary reserve currency. But he does think that the world will become more multi-currency, For example, like we were seeing with Russia, and they're demanding rubles, to trade in rubles for various commodities such as oil. Now I'll quickly give my take on Luke Gromen's sovereign debt crisis prediction. What I do think is correct is the medium to longer run outlook, and the debt issues that the U.S. faces, and it really is just a mathematical accounting issue. It's clear that eventually a lot of the entitlement programs and the spending that the government currently does is just going to have to be defaulted on or printed away. And so I don't believe that the Fed can tighten that much more. And just like Luke Gromen says, tightening creates a lot of pain in the economy, which is very highly indebted. And so ultimately they're going to end up easing and inflation is really going to rise. But where I do differ is his take on the dollar. I think looking around the world at other central banks, they face similar, if not even worse, problems. Just looking at banks or countries such as Japan or the Eurozone in general, what we're seeing is ECB just rose rates, but they rose rates to zero, and they're still kind of doing a sort of QE program, or what they call an anti-fragmentation program. And Japan's been, or the BOJ's been easing aggressively with yield curve control. So even if the Fed does pivot, other countries around the world might be in even worse positions, or in easing even more. And so relatively, the dollar might still rise. And this kind of goes in line with Brent Johnson's dollar milkshake theory, which I might get into in a different video. And next, there's still also the possibility that when the crisis does come from tightening, that we end up getting a repeat of 2008 or 2020, where the Fed does QE and then interest rates really go down, markets go up, and we end up in the same place as we are now. You never really want to underestimate the policymakers' ability to really kick the can down the road. But at the same time, with inflation being where it is, maybe this time it really is different, and perhaps there really will be a debt crisis situation that's upcoming.